Now allow me to introduce someone that some of you know very well. Dr. Patrick Magidi is the Dean of the Villanova Business School. But there might be something about him that you don't know, in that he hasn't always been in academia. Prior to academia, Dean Magidi, Dr. Magidi, spent nearly 15 years in the steel and mining industries, where he founded 2 successful companies, held a variety of roles, including Chief Executive Officer, Director of National Sales, and Board Member. He received his PhD in Strategic Management from the University of Maryland, an MBA with high honors from Johns Hopkins, and a BS in Chemistry from St. Joe's. More importantly than all of that, he is a friend of the show, and we're absolutely thrilled to close our book club year with him. Ladies and gentlemen, Dr. Patrick Magidi. Thank you, sir. Such a pleasure. Thank you for being here.
Good morning, everyone. It is absolutely my honor to welcome you to Villanova University. As TC mentioned, I'm Pat Magidi, and I'm very proud and honored to be the Dean of the Villanova School of Business. I thought I would take a chance, since some of you may not be as familiar as others with Villanova University and the Villanova School of Business. I figured it was my job to give a 30-second commercial for the school, so I hope you'll bear with me. But Villanova was just recently, the university was just recently named for the 20th consecutive year the #1 master's granting institution in the Northeast United States. The Villanova School of Business, in particular, has enjoyed success the last number of years, and we have graduate and undergraduate programs that are ranked in the top 15 in the country. The undergraduate program, in particular, has been in the top 15 of undergraduate business schools for the last 4 years, and we are the only unnamed business school to be found in that top 15. So I'll be taking names and numbers after the program for those of you that would like to name the business school. We have about 1,700 undergrads in the business school and about 600 graduate students. Last year, we're particularly proud of the return on investment we provide our students. Last year, we placed 98% of our students within 6 months of graduation at an average salary of $55,000 a year and an average bonus of $6,000 a year. So we work very hard to get our students jobs, and it sometimes seems like we live in a parallel universe when we read so much bad news in the paper about jobs, and we have such an embarrassment of riches here at the Villanova School of Business. It's my honor to host this event and book club. I met Michael Smerconish last year. He served as the keynote speaker for our biggest event of the year, the Villanova School of Business Business Leaders Forum, in which we bring together 200 distinguished business leaders and alumni, and he was fantastically received at that event. And so we're thrilled to partner with him again for this book club event. Michael, let me tell you a little bit about Michael Smerconish. He's a nationally syndicated radio host, newspaper columnist, author, and MSNBC contributor. He's guest hosted for Chris Matthews and has been a guest on virtually every cable television program where politics are discussed. He's known for sharing stories about topics that bring people together while discussing the political issues that divide us, while addressing polarization in D.C. He was the first radio host to interview President Barack Obama, has interviewed Presidents Jimmy Carter, George H.W. Bush, Bill Clinton, and George W. Bush. He's been the author of 5 books himself, 2 of them New York Times bestsellers. Philadelphia Magazine has named him one of the city's best talk show hosts, and as well as one of the city's most powerful citizens. So again, we're very happy to be partnering with you, Michael, especially given your powerful status from Philadelphia Magazine. We are also, as the Dean of the Villanova School of Business, or any school of business for that matter, I can't imagine a higher honor than to introduce Mr. John C. Bogle. It's quite an honor indeed. Mr. Bogle created Vanguard in 1974 and served as chairman and CEO until 1996 and senior chairman until 2000. He's known as one of the world's most distinguished and innovative business leaders. The Vanguard Group is the largest mutual fund organization in the world, and I'd like to take this chance to tell you that it employs over 400 Villanova alumni, making it our largest alumni employer. So thank you very much for that too, Mr. Bogle. He is also no stranger to Villanova himself. In 2011, he received an honorary degree from the university, a Doctor of Commercial Science. So he is actually Dr. Bogle. Time magazine has named Mr. Bogle one of the world's 100 most powerful and influential people, and Fortune has designated him as one of the investment industry's 4 giants of the 20th century. On behalf of Villanova University, and without further ado, it is my distinct and honored pleasure to welcome Michael Smerconish and Jack Bogle.
Good morning, Good morning, Dr. Bogle. When you hear Dean Magidi talk about Time magazine saying that you're one of the 100 most powerful in the world, and Fortune saying you're one of the 4 investment giants of the 20th century, there must be a part of you that says, not bad for a guy who in the autumn of 1948 had a D+ in economics at Princeton and was close to failing out. How did you turn that situation around?
Well, we had just a funny thing going on at Princeton where you had to have we used to use 1, 2, 3, 4, falls a D, and you had to have a 3. You had to be in the 3s or you lost your scholarship. And in the middle of my sophomore year in my first economics course, I got a 4+, a D+, in the first semester studying Dr. Samuelson's book, Economics, Basic Analysis. So I had to do something about that, and I proved I wasn't the smartest, sharpest knife in the drawer, they would say. And, okay, good, thank you. So I just went to work and got to C-. And the scholarship didn't go away. There wasn't anyone else who was going to pay my way at Princeton, no one that I knew of. So if I hadn't gotten that mark up, I would have been out of school and had to go to work a little bit earlier than I expected to. But, you know, life is funny. You grow, you gain a little bit of wisdom along the way. You sometimes come to realize a task might be a little more demanding than you thought. And you get supported by great faculty who are trying to help you get through all this. And so my grades got better and better and better. And I finally graduated with high honors. So it was a nice turnaround, made even more elegant, for want of a better word, by the fact that this book by Dr. Samuelson, he became my friend over the years, and he wrote the foreword for my first book in 1993, Paul Samuelson did. And I dedicated I think it was my 8th book to him with his permission. So we had a great relationship, beginning with him almost being the instrument of my demise at Princeton University. So life is full of turnarounds.
How's the audio in the back of the room? We need more. We need more from Mr. Bogle? Okay, we're going to get it. Don't worry, we're going to straighten this out. Thank you, sir. Jack, you wrote about mutual funds in your 1951 senior thesis at Princeton, and I have some of the language that you used. You said, only if we, quote, serve individual and institutional investors in the most economical, efficient, and honest way possible. You were very idealistic then. Are you equally idealistic now?
No. I'm much more idealistic now than I have ever been before. No, don't, we're all getting, many of you in the room too with me, are getting a little bit old. Hang on to your idealism. There's no point in living a life without idealism.
Before we delve too deeply into the subject matter, we should talk a little bit about Vanguard and the concept of indexing and what it was that you proposed that caused some of your critics to say that you were anti-American, that you were against capitalism. Paint the broad strokes for me as to how you approach this.
Well, an index fund is a fund that says it's fine to be average. They don't like that out in Lake Wobegon, as those of you who listen to that show is. Everybody's above average out in Lake Wobegon. We all know that. But everybody in the financial world is not above average. Everybody is average. all of us together, except we lose the market by the amount that Wall Street extracts from us. So it's a very simple, basic idea. It hardly fits into this increasingly quantitative world. I mean, I read the Journal of Portfolio Management and the Portfolio Analyst Journal, and they've got quantification in there that has to be seen to be disbelieved. They think they can prove anything with numbers, and they end up not being able to prove anything. The idea is to get Wall Street out of the picture and earn your fair share of whatever the stock market is, or the bond market for that matter, what your fair share of whatever returns that market, which is out of our control. We can't control that, but we can control getting our fair share of it. And you do that by taking all the costs out of the equation, the trading costs, the capital gains tax costs that mutual fund investors are subject to, those huge management fees, which, believe it or not, eat up 2/3 of the dividend income you get from your typical mutual fund. 2.1% gross yield, manager takes 1.4%, and graciously passes along a third of the return of your money to you. And they talk about taxes being too high. That 67% tax by the manager is higher than anything that Barack Obama or even, I suppose, Mitt Romney is talking about or was talking about. So the idea of indexing is simplicity writ large. Its creation is a result, I'm sorry to say, of someone who is not the sharpest knife in the drawer, who loves simplicity, and it works. And it is guaranteed to work in the future as long as the mathematics prevail. Gross return on the market minus cost equals net return. And the low-cost provider wins. This has been the theory of Vanguard since 1874. At the very beginning, we talked about low cost, low cost, low cost, and it works. So the way to own the stock market is through an index fund. That is the best way. Now, people, you want to experiment with an actively managed fund, please be my guest. But put that in the funny money account. In the serious money account, put it into an index fund. And, I used to say, put it into the lowest cost index fund, which is a way of commercializing Vanguard. But now all our, which I don't intend to do, but now all our rivals are picking away, and if we're offering something at 6 basis points, they want to offer it at 5. I wouldn't worry a lot about that. These firms may or may not be around 10 years from now, but I'm sure we will. So, pick a very low-cost index fund as the basis for your investment program. It may do very badly. If the stock market does badly, I guarantee your index fund will do badly. There aren't any easy answers here. The trick is, in this convoluted, greedy world, to make sure that whoever you choose to manage your money acts as a fiduciary for you and gives you your fair share of whatever the market is generous enough to give us or mean-spirited enough to take away from us.
You said something to me on the radio, and I wrote about it in my column on Sunday in the Inquirer. You said, above all else, don't peak. Will you explain that?
Yeah, that was a nice column, by the way.
Thank you.
I really enjoyed that, and it was accurate. Which your columns always are.
You say that with some surprise.
We confound ourselves and destroy ourselves, really, by the emotions that we feel toward the stock market. The stock market is a really dumb thing. It's trying to measure the value of your assets every minute of every day. That simply does not matter. In fact, it matters in a negative sense. It gives you what we call behavioral problems. The market goes way up, and when it's way up, you're optimistic. You want to buy more. Of course you are. That's why the market is up. And when the market plummets, your first thought is not to buy more. Your first thought is to get out. So now we've got you buying in at the high and getting out at the bottom. This is not a formula for investment success. So don't be misled by the stock market, because underlying the value, the price of the stock market, sometimes it's way ahead of its underlying value and sometimes way below. But the idea is that there are these great corporations in America, and for that matter all over the world. They have tremendous amounts of capital. In the U.S. alone, maybe $12 trillion of capital. They earn money on that capital. They innovate. They manufacture. They use technology. They become more efficient. They create better products and services at lower and lower costs, so they make money. And when they make money, they pay part of that out to you, usually in the form of dividends. This is not complicated. And what's left, they reinvest in the business to make still more money. So corporate America has been as far back as we can go, 1871, I think we have data to, has been a winner's game, going in pretty much not a straight line, because we do have recessions and depressions in the 30s. It broke that line, and it did break it a little bit back in 2008, 2009, when the banks fell apart and those bank values fell down very sharply. But if you can ignore these fluctuations around what we call intrinsic value of corporate America, that's your best strategy, because you're tempted to do the wrong thing at the wrong time over and over and over again. So when you get your 401k statement or your IRA statement or your regular mutual fund statement, don't look at it. That's what I mean by don't peek. And I tell people who are investing for the future, let's say in a 401k plan or a thrift plan of some kind, you got a quarterly statement, throw it away. And if you really have to look at it maybe every couple of years. But if you don't have to do that and you never look at it, think about this with me for a minute. If you never look at that statement until the day you retire, that's the only day it's important in all this, how much your assets are, you won't believe. You'll think somebody's lying. You look at this colossal amount of money that's just the result of compounding and regular investing in an intelligent way, an intelligent, low-cost way, over 40 or 50 years for the young people today, or 60 years. And it will be incredible. He said it can't have, must be inflation. Well, there will be some inflation in there, of course, but that's the way to approach it. I mean, I do hyperbolize a little bit, something I have not been exempt from in my long career of speaking, so I hyperbolize a little bit, but it's basically trying to make the point that these daily movements in the stock market, if I could quote Shakespeare, is that okay? Please, here at a business school? The stock market, the daily moves of the stock market are like a tale told by an idiot, full of sound and fury, signifying nothing. Always quote Shakespeare when you get a chance, Michael.
You've had this stellar career, 61 years in the business. You've already authored 9 books, 6 heart attacks behind you, a heart transplant.
10 books.
Well, this is number 10.
That's number 10.
So that's my question. What is it that you felt compelled to say in book number 10, The Clash of Cultures?
Well, let me just say this, that my first book, 1993, it was called, modestly enough, Bogle on Mutual Funds, and it turned out to be an incredibly successful book because I was telling the truth to the reader about what the world of mutual fund investing was like. It was pretty much unprecedented. Warren Buffett wrote a wonderful blurb for it. Everybody that saw the book, they've compared it to the best books ever written. I don't think it is, by the way, but they've compared it to the best books ever written, like The Intelligent Investor, Benjamin Graham's great classic. And some people said it was even better, but it was just simply telling the truth about how to invest and what goes right and what goes wrong in the mutual fund industry and what's important and what's not. And so I started off on my writing mission. I was still running the company at that time, so I had to carve out a lot of time to do that, but I thought it was worth it. Started off being, let's get the truth out about investing in mutual funds. And I gradually morphed a little bit with a variety of different subjects. I have a book called Character Counts, which is the history of Vanguard as it was told, speeches that I'd given out there to our crew. By the way, crew members, there are a lot of you here. Thanks for coming out. Forgot to say that earlier. Thank you. And thanks for making me look good. So then I wrote a collection of speeches which included my senior thesis at Princeton called John Bogle on Investing the First 50 Years, leaving hanging the implication that there might one day be a book called John Bogle on Investing the Second 50 Years. Now you laugh, but since I got a heart transplant from a 26-year-old man, young man, in 1996, who's to say that I'm not thinking about that book? I promised my wife I wouldn't write any more books, but if I make it to the second 50 years, I'm going to break my promise. I don't think she needs to worry about that. And then I get into more of a societal thing, talking about what's wrong with capitalism. My book, The Battle for the Soul of Capitalism, which is published by Yale University Press, and I didn't know what they wanted. They wrote me a letter saying they wanted to publish my next book. And I had no idea that I was going to write next book. But, well, I went to Princeton, but Yale is all right. And So I decided I would write a book about capitalism and how it was deteriorating and how that fit into the social pattern of America and the American Empire, which I contrasted to the Roman Empire and the decline and fall of the Roman Empire. Lots of parallels there. And then I wrote another little book all about investing called Little Book of Common Sense Investing. And there's kind of a funny story there because it has been the #1 mutual fund book on Amazon every day except like a few more than one, for the last 5 years. Kind of an amazing survival record for it. It's just a simple book giving simple directions, but it's been the #1 book all those years. And the kind of amusing story is that Joe DiStefano, the Inquirer writer, had a headline saying, "Bogle knocked out of first place." And a book called, I don't know what, some funny jazzy name, had replaced me for a day on Amazon as the #1 fund book. It was a brand new book. And so I wrote to Joe and I said, "I really enjoyed your article, but check the rankings tomorrow." And the book lasted for one day there. And in recent days, it's been supplanted by this book. Periodically, they go back and forth as #1 and 2 books. But this also is all these approaches are, I hope I'm not beating this point to death, but a whole variety of things that I've wanted to do and say in my books. And this one is about the parlous state of capitalism in America today, somewhat like the battle of soul of capitalism, but how we've turned a perfectly good society dedicated to long-term investing when I came into this business in 1951 into a society of speculation, an investment culture of speculation. And it's just not good for society, it's not good for investors, and it's fantastic for Wall Street. Sorry about Wall Streeters out in the audience if you're there. I think they don't come to these things. But it was to basically tell the story of where we are today and some ideas about how to fix it. But also, importantly to me, and this is a lot of this stuff is ego trip. I admit that. I would admit it even though my wife isn't here. She likes me to mention that, but it's a little problem. But it's also, I've been, in a way, at the edge of history, in the process of history of this industry since 1951. And there are a lot of things that will never be known and never be told. If I don't, probably I've been in this industry longer than anybody else, and hope to be around for a little while longer. But I've had experiences in the real world of mutual funds, things that have gone right, which I have done, things that have gone terribly wrong, which I have also done. I've done some things that are so stupid that I might write a long, long, long book about my stupidity for the next one, but I'm not going to write the next one. That's why. And so I made a lot of mistakes and learned from them, and I want investors to have that chance. And then I wanted to record things like the history of the Wellington Fund, which is the fund I went to work for Mr. Walter Morgan back in 1951, and pay tribute to him. And if I hadn't put that history down, it would be gone and forgotten. And I believe we can all learn lessons from history. So it's an amalgam of investment advice, history, societal problems, problems of the financial community in general, cultural problems, and the only one I'm really expert on is the financial side of things, or the mutual fund side of things. But I have strong ideas. I'm able to, I think, look back and put a little perspective on what goes on in the world that is very helpful, because what happens is, I hope it's helpful, because what happens is we get wrapped up in the day-to-day in all our lives, your lives, my lives, everybody's lives. We're wrapped up in the moment, and we should stand back and take a look. I tell people, I think this is relevant, that for many, many years I've been going to the Investment Company Institute annual meeting, which is very depressing. A whole lot of marketing people there, no investment people there, and they talk about how great this industry is ad nauseum. And but I go, and people say, "Why do you go?" And I say, I go for one reason and one reason only, in the hope that I will get there, spend 2 or 3 days there, and find a hint of introspection. And alas, every year I come home empty-handed, but I come back the next year, and I'll go back this year, and hope to find it without, I must say, very high expectations. So I am, I guess you could say, kind of a reformer from my thesis on, and someone who really cares and is concerned to do your best. You know, as William Penn's going to tell us, we do what we could do it now, do whatever good you can do now, for we shall not pass this way again. And so I guess it's for all those reasons. But it comes back, I think, to your first question about idealism. You know, you've got to be an idealist to try and see what's wrong and then fix it.
In Oliver Stone's movie Wall Street, the Michael Douglas character Gordon Gekko says, "Greed is good." It sounded unseemly when he said it, but I think many of my generation in watching the movie were spurred toward careers on Wall Street and thought that, unseemly that it might be, it's good for capitalism. Is greed good for capitalism?
Well, quoting President Clinton in a way, it all depends what the meaning of greed is. So, greed in the abstract, no, it's not good. It's not good for anything. It's probably sinful. Ambition, the hopes of accumulating wealth, perhaps for foundation or for society or for your family, is up to a point, an appropriate thing to do. You know, money has kind of become the scorecard of America. I think that's tragic. It's as if money is all there is in the great game of life, and it's important to be sure. None of us want to be destitute, but excessive greed, and it's just, you know, not a very attractive human characteristic. But more than that, well, he's making the point that greed is good because it enriches him. It enriches him. Well, that comes at the expense of somebody else. You know, if you think about the stock market, for example, being a kind of a closed system, you know, people don't come into them as a group, don't come into the market and get out of the market. If you get out of the market, somebody else comes in. If you're selling your Google or whatever it might be, somebody else, I hope you're all sitting down for this, is buying it. There is no value created there by the stock market. The stock market subtracts value from that corporate America generates. It's as simple as that. People don't like to hear it. It is absolutely true. It's just mathematically true. And I love the, you know, it's great to have an idea that built Vanguard that's based on mathematics. The relentless rules of humble arithmetic, I call it. Gross return minus cost. I said this before, equals net return. And I love that phrase. It's from Justice Brandeis. The relentless rules of humble arithmetic. And that's what Vanguard is all about. And it doesn't have anything to do with greed, although we all have a little bit of greedy thing. I'm sure I do too, except the way I was brought up, which is a very humble, modest background. I hate to spend money. So there are a lot of ways of looking at things, but if you accumulate a decent amount of money, which I have, it's one thing to earn a fortune and spend it and still have a fortune left, but it's quite another thing to earn something short of a fortune and not spend anything. I hate to go into stores, particularly at this time of year. I'm getting even a little tired of Little Drummer Boy. Apparently that's politically correct, though. You can do him.
I guess what I'm asking is if there's enough sex appeal in the Bogle philosophy for today's masters of the universe. You were called Un-American. They regarded this as Bogle's folly because you set out to mirror or keep pace with the market, and today's mantra is that's not good enough, you've got to beat the market.
Well, of course that's what's happened, and everybody thinks they can do it, but everybody, all the managers put together, are average. You know, if one manager is beating the market by, let me say, an extreme amount, say 2% a year, another manager is losing to the market by 2% a year. There's no way around it in this closed system. And this is documented by academia. They look at the reports everybody files every quarter, all the institutional managers file. And you would think that the dumb individual would be outpaced by all these smart investors. There is absolutely zero evidence that professional managers add value, and that's when you use your common sense. You realize that. They may be brilliant, but they're competing with other brilliant people. So the market is, in a lot of ways, a big sham, a distraction from, I say in one of my books, always a good idea to quote oneself as well as Shakespeare and somebody else, but the stock market is a giant distraction to the business of investing. And it is we think about the market, and it means nothing except a distraction that brings our worst impulses to bear.
You talk about the failure of gatekeepers. There's a whole discussion in The Clash of Cultures, and you name names, or at least institutions. You blame Congress, the judiciary, the SEC, the Federal Reserve Board, ratings agencies, public accountants, the financial press, security analysts, directors, and stock owners. We're seated in the Villanova School of Business, and as I was preparing for this conversation, I was thinking, what role, if any, do business schools, academia, those who are training tomorrow's leaders in business, what responsibility do they bear for the circumstance you described?
Well, I think they bear some responsibility, but the prime responsibility to me for, let's say, something like ethical behavior. Business schools almost universally have a ethics course or two, something a little more than that maybe. But the people that come to business school have grown up in families with certain sets of values, and those values have gone astray in a lot of places. And it's hard to re-educate somebody's value system. It's hard to teach ethics if it doesn't come from within. So I think they should be trying. I think they probably spend too much time on all this modern capital market theory with all these equations, as if everybody that understands, that takes a business school course on investment management, for example, everybody is going to be above average. They're defined. You should understand the basic financial system, the basic way that corporations work, how earnings are created, what intrinsic value is, what discounted cash flow is. All those things are necessary to understanding the business. But I would spend more time on ethical behavior, and I'd also spend a little time, although this is very difficult, to encourage people to go into professions, trades that add value to society. The stock market subtracts value from society. Wall Street subtracts value from society. Inevitably, as long as gross return minus cost equals net return. And people don't like to be reminded of this. And there will always be that great exception. And people say, yeah, I understand what you're saying, but what about Warren Buffett? I say, name two. So then after long thinking, they say, what about Seth Klarman, another excellent money manager? And I say, name three. But, nobody can get to number 6, believe me, nobody. And they come and go in this great new book that you have the opportunity to invest in this morning. Was a commercial allowed, Michael?
Sure.
I have, and this is a very, very important thing, one of the most important, I think, lessons in the book, and that is it's called reversion to the mean, which is the first fundamental rule you have to understand. I'm sure business schools teach it about mutual fund returns. And I've taken the 8 or 10 most successful mutual funds of the modern era. Things like Magellan Fund, things like Windsor Fund, because this book is neutral in terms of it is not a commercial for Vanguard. A lot of it is, but a lot of it is not. And there's certain feeling among some of our managers out there that this book discloses too much. I don't know how too much disclosure is bad, but that's another story. But in any event, I show these funds. Each one of them has virtually the same pattern. I chart it. And here's T. Rowe Price Growth Fund. And they go up to a peak, and then they fall away. And it looks like 8 mountains in there. Boom, 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 boom. It's a universal pattern. And you get above average, and then you fall back to average or below average. And it happens because there's a lot of randomness to begin with in fund performance. And while there's some skill, managers change. Fund gets too big to manage. Very good example was the famous Fidelity Magellan Fund. And when Peter Lynch, who did a good job managing a very small fund with a huge organization behind him, did a great job from say 1974 to 1992. Part of the time the fund was so small it didn't have any public shareholders, so that record's a little dubious. But he did a good job when he ran it. And it fell apart after he left. Its assets had gone from essentially nothing to $110 billion. And then you go down the other side of the mountain, its assets are now $10 billion. $100 billion. has left the fund, partly by market depreciation, partly by shareholders who thought they bought a miracle. And I'm just using this as one example. They're all over there. I don't mean to pick on him. Anyway, it's just a fact of life in the securities markets. So you can't really be sure you'll win ever. And you can be quite sure that when there's a peak, and it's a little hard to know whether the peak will be succeeded by other peaks, but there will be a downturn. I mean, that's what basically I would guarantee. So don't jump on the winners, even though someone says, what about Peter Lynch? And mutual funds are particularly bad in this case because based on the data of the last 20 or 30 years, half of the mutual funds that are around today won't be in business 10 years from now. So here this industry tries to say they're for the long-term investor, but if half the funds don't last for the long term, how can you be a long-term investor in it? There's just no way. So, and to make matters worse, the turnover in fund managers, in other words, the fund survives, but it's going to have a new manager every 5 years. That's the average. So if you're thinking about a lifetime investment program, you're going to think, you know, if I have 4 actively managed mutual funds and they all survive, the odds are greatly against that. In 25 years, I'll have had 25 managers manage my money. In 50 years, it'll be 50 managers. There is no chance in the world, zero, that fund will outperform the stock market in the long run. They're taking too much money out, and the odds are that they would be an average performer over that period, but they take the money out. Money comes in and out of the fund at bad times, and they end up doing a very bad job. So this industry needs some introspection, Michael.
You're very critical of institutional money managers in the book. You talk about their timidity. You also discuss in broad strokes concepts of absentee ownership, and there's, I think it's in a footnote where you quote former Treasury Secretary Lawrence Summers as asking, and I love this because this allows someone like me to understand your point. When was the last time someone washed a rental car? Will you speak to that theme in the book?
Yeah. Part of it is the system that we have of much more speculation, short-term speculation, crowding out long-term investment. And the turnover, for example, is when I came into the fund portfolio turnover was about 16%, meant the average fund held the average stock for 6 years. Today, turnover is 100% a year among equity funds in this business. That means the average stock is held for 1 year. I think you could call 6 years investment and 1 year speculation. But my friend Steve Galbraith says we've moved from being an own-a-stock industry to being a rent-a-stock industry, hence the rental car example. You just don't care about corporate governance in this case if you're renting the stock and not owning it. As a matter of fact, you shouldn't, think about this for a minute, you shouldn't care about corporate governance if you're running a stock. You're holding that stock for, in some instances, 16 seconds. That's what this high-frequency trading does. Go figure. I mean, I don't know what the point of that is. But 16 seconds to a year or a day or a month, and you don't care whether the board of directors is minding the store or not. You're holding it for a lifetime. Of course you care. It's your corporation. So we get into a lot of trouble because our focus has changed from long-term to short-term. And I'm not, unfortunately, I have to be honest with you, I'm not sure that even if we were long-term, we'd be doing a much better job on corporate governance. Institutional investors are very bad guardians of the welfare of the shareholders of the corporations in their portfolio. Very bad, very low grades, and mutual funds are among the lowest in terms of activity in corporate governance. We measure that in the book, and not by some whole bunch of little quantitative things, but we look at how often funds vote for the board of directors that have been selected, how often they vote for management compensation proposals, and then how often they vote for shareholder compensation proposals. And in very round numbers, they vote for 90 directors 98% of the time, vote for management compensation proposals 94 or 5% of the time, and vote for shareholder performance compensation proposals 5% of the time. And that's a decent measure of how involved you are. Are you going to stand up for the shareholders or not? And even if you're owners, and there are owners, I should say that the ultimate owner, the ultimate responsibility for the governance of corporate America, growing every single day, is the index fund. Because there's this old Wall Street rule called, if you don't like the management, sell the stock. That goes back to the time, I think it's quoted in my senior thesis back in 1951. But if you're an index fund, you can't sell the stock. So the principle, the tenet, the organizing methodology should be, if you don't like the management, fix the management. But there is silence. The chapter in the book, I think, is called The Silence of the Funds. We don't fix the management. And in Benjamin Graham's Intelligent Investor, first edition, 1949, great book, probably 20% of that book is devoted to what should happen when a manager doesn't do the job, corporate manager doesn't do the job. And he's looking for activist investors who will say, you can do a better job. Where are the where are these institutional owners, which own 70% of all the stock in America? And mutual funds themselves own 35% of all the stock owning. Where are they when you get these absurd executive compensation plans that pay people because a management consultant says you got to be paid as much as your peers? I won't get into that unless you want to get into that further. But they're quiet, silent on investment executive compensation. And they're also, I find, disgracefully standing back from allowing the corporations and their portfolios to make political contributions, sometimes even undisclosed, at their heart's content. And I don't see why a corporation should be giving the shareholders' money to the manager's favorite causes. There'll be some that will argue they have to do that to avoid burdensome regulation, and there's, in fact, of course, some truth to that. But in general, I think a bad thing is happening when corporations are allowed to give away your money, a little bit like labor union thing we talked about, without your consent. And I've been trying to do some work, I describe it in the book, in that area, to get some life into these corporations. But it's very hard, in part because when you think about the mutual fund industry owning 35% of all stock of just about every company in the country, they've just got to stand up and be counted. And if they don't, nobody is.
Jack,
so you have a responsibility.
May I ask on that issue, in the book you make reference to your New York Times opinion piece where you advocated for stockholder approval before there would be political contributions. Did anybody take your advice?
One person. and let me just give a little background on that. I think it was Justice Kennedy writing, I believe, for the majority in the Citizens United case, which opened the door to these contributions, said if the shareholders don't like it, they can use the mechanism of shareholder participation to fix it. Nobody is using it. It's a tragedy. And I wrote an op-ed about this in the New York Times, which is very hard to get in. I had to call a few of my friends up there, like Gretchen Morgenson. She put me in touch with the right people to get some. They get tons of submissions. And so the op-ed said we should have a proposal before every corporation say, resolve this corporation may make no political contributions without the consent of 75% of its shareholders, a supermajority to allow the corporations to break this bond. And nobody paid any attention to it in the industry. This industry has never submitted, mutual funds, never submitted a proposal in a shareholder proxy in its history. Never. The biggest investor in America doesn't propose anything. They don't want to propose anything. But in any event, sort of by accident, a fellow I know, not a close friend down here, inherited a bunch of stocks some years ago and just hung on to them. And he decided he would pick up the cudgels. And so he wrote to all the corporations, all by himself, wrote to the corporations that he inherited this portfolio was on, I think, and said he wanted to put this proposal in, the very proposal, 75% approval before he can give anything. And it's a tortuous process. It requires lawyers. He had none. You have to promise to go to the annual meeting, and he couldn't afford to go to annual meetings on the West Coast. And the corporations fight it. But finally the SEC said the proposal could go in. And when it was all said and done, he did get the proposal into the Johnson & Johnson proxy, meaning it's a it's an acceptable, the SEC says it's an acceptable thing for shareholders to propose. They have the last say of what can go in a proxy or not, the SEC does. And it got about 6% of the vote or something. Not very good, but of course Johnson & Johnson argued, and I've said before there's some merit in this argument, that they need to do all these contributions to avoid Johnson & Johnson being wiped out by the bureaucrats. That's a little bit hyperbole there, but that's the essence of it. And the shareholders agreed with him. But he's going to do it again, and maybe other people will do it again, and will do better and better over the years. But, you know, as another, I'll give you one more quote, Chinese saying, a journey of 1,000 miles begins with a single step. And so I'm not above thinking that single step may advance the ball toward responsible corporate governance.
I'm going to question you for 10 or so more minutes, and then we're going to open up questions to folks in the audience. So start thinking if you have a question for Mr. Bogle. You mentioned Citizens United and political contributions, and it brings to mind current affairs. What are your observations as you're watching the fiscal cliff negotiations play themselves out in Washington?
Well, of course, it's appalling that we ever let ourselves get into this position. The political system is clearly broken. I tell people, you know, they can't, the only thing, as far as I know, of any major status they agreed on in the Congress, both parties agreed on, it was passed easily. It was probably the worst securities bill in the history of the securities business. It's called the Jobs Bill, and it sounds like it's for jobs, and it really is not. It's for allowing very small companies to go out and solicit money without prospectuses, without any of the government regulations. It just opens the door to, you know, bucket shop kind of operations, marginal operations, without the protections that we all take for granted in this country. Regulatory protections, disclosure, transparency, and all that. So it was a bad bill, and it passed almost unanimously in both the House and the Senate, and yet they can't get anywhere on the just a complete deadlock on all these other issues. I am absolutely convinced that the fiscal cliff, so-called, is not going to arrive. First of all, it can't. And those parties are just going to have to get together. They can't let it happen. I don't know who's going to give the most. I mean, one might argue, I would argue, that since Barack Obama won the presidency, he should give less than the other side, but he will have to give something. The Democrats will have to give something to the Republicans. But even the Democrats are somewhat entrenched on not backing the president's proposals. And John Boehner, of course, has got to deal with, you know, all the Tea Party people who seem to be easing back on their influence down there. So it's a really messy political system. But you have to believe that there's a reasonable compromise. And, you know, you see the lines kind of closing, how much should be in the form of tax reduction, and whether that tax increases, and whether that should come in the form of rates. And some unelected guy named Grover Norquist apparently runs the country in terms of rates can't be changed. I mean, really? What kind of a nutty world is that? And who is he anyway? Has he ever been elected even dog catcher? I don't know. I don't get this system very well. But in any event, there will be some combination of... There's apparently a huge difference between raising your taxes by eliminating deductions and actually raising the rates, even though the amount of new tax you pay is unchanged. I'm too simple to get that difference. But there will have to be, we know, everybody knows, the Democrats certainly know, there just has to be some reduction in things like Medicare and Obamacare, I guess it's called. And it used to be a sign of opprobrium, and now Obama apparently likes it, likes having care named after himself. I guess that's okay. But they will come together. And it's just my conviction. Most of you, or many of you certainly in the room, know as much about it as I do. I mean, I'm an avid reader of the newspapers still, and you know, so you know as much as I do. But at this point, I'd like to quote Churchill. Could I have one more quote, or am I using up my quota?
It's Churchill. Go ahead.
Churchill says, "Americans always do the right thing, but only after they've tried everything else." So I don't know the difference quite between an optimist and idealist, but that's an optimistic statement, but it's also an idealistic one, that people should be able to, and our elected officials must be able at some point to reason together and fix this. And it's going to happen. I don't know to what degree, but does it really matter to anybody in this room if it's 40% tax increases and 60% spending cuts, or 70-30 or 80-20. They argue about those things, which are really immaterial to all this. We give it much more weight than we should.
The book is largely praising of Vanguard, but as you've made reference to in our conversation, in some respects, there are areas of criticism. Exchange-traded funds come to mind. What's it like for you on a day-to-day basis to be at this enormous entity that you created but today are not running?
Well, that's a good question, Michael. Obviously, I can't. There's a little bit kind of, you can take the boy out of the country, but you can't take the country out of the boy with me. I can't just endorse views that I don't hold. I have to say what I believe. It's a little compulsive. I would be at the bottom of the list of anyone that could ever run for public office. So it's not so easy. There's a lot of feeling that the book has. A lot of people would look at that book and say it's kind of a Vanguard commercial. And of course it is. Those are the ideas I put into it, and it's working out in an incredibly successful way. Has the approval of investors all over the world. Just kind of our methodology and our idea for indexing and low cost is basically a very strong trend, stronger than ever this year, and it's going to get stronger and stronger. I don't know what our poor competitors are going to do, but I have to, rightly or wrongly, not worry about offending people, but saying what I believe to be the truth. Am I really the great purveyor of the truth? Someone else has to make that judgment, and that's not the point. Is not. I'm not trying to make the point that I'm necessarily always right, because as I think I mentioned before, I've made so many mistakes in my life. Oh yeah, that's by my 11th book, mistakes I have made. But so I'm not saying I have the truth. I have somehow the given truth. But what I am saying is, if you believe something profoundly and seriously, you can't just be a consensus person and say, okay, if that's the decision, I'll go along with it. I try and be a little bit quiet about my opinions, but then you get some great interlocutor like Michael Smerconish, and he draws it out of you. So it's a little bit uncomfortable, but maybe even more than that. But I've got a wonderful staff of four counting me, and we get a lot done every day. I'm doing a lot of speaking, doing a lot of writing, doing a lot of interviews, many connected with the books. But I think gradually, at this stage of my life, not because of pressures on me, but just because age takes its toll. Yes, it does. I call it a progressive disease, which the ending is never in doubt. Think about that. So I want to be a little fair to my wife and be home a little bit more, and trying to accommodate my schedule along that line. But I'm going to be speaking out, I think, until my dying day. I just don't know how to do it otherwise. And you can tell me, and you probably would, be tactful, compromise. I'm not above a compromise here and there, but I can't compromise on principle. I just don't know how to do that. And whether that's a good thing or a bad thing, I will leave to all of you to decide.
Final question from me, at least for now, and then we'll have about 15 minutes of questions from the audience. Look into your crystal ball and talk about the stock market and bonds. Where are we going generally?
Okay, well, let me just say that I have for many, many years, decades in fact, tried to look at the stock market through the lens of the value created by corporate business. Because the value added or subtracted by expectations market, people paying 40 times earnings for the stock market compared to 10 times earnings for the stock market, basically evens out over the long run. So I look at the stock market, my little formula, which people are starting to recognize a little bit, is where do those business returns come from first? And those business returns come from corporation dividend yields, start with today's yield if you're looking ahead, and the future earnings growth. And today's yield is around 2%, fairly low on stocks, and earnings growth could be 5% a year. I think that might be a little bit high, and that's, of course, nominal and not real. Inflation will take a bite out of that. but I take inflation as a separate issue. So that would be a 7% nominal return on stocks over the next decade. 2 plus 5, the simple math. I don't think that I think expectations for the market are about right at the moment. Therefore, I don't expect that today's price earnings multiple, the speculative element, the market element in these fundamental returns generated by business will take that 7% up or down very much. I should say, much more than parenthetically, that we went through the 80s and 90s with speculative return adding 7% a year to stock prices. So if that were to happen here, that 7% would grow to 14%, and if it were to be reversed, it would go from 7% to 0%. But I think it's about right if you can handle those mathematics. I think that the market is about fairly valued today, barring some kind of a catastrophe, which an apocalyptic event, which don't usually happen. Apocalyptic events don't usually happen, but they always can happen. And so I think you want a little protection from that. You certainly want some bonds in your account, no matter large or small, old or younger. I have a sort of a mental rule that the bond position or fixed income position of your account should be have something to do with your age. A lot more protection when you're older, a lot less when you're younger. And I should say, again, much more than parenthetically, that you better count Social Security in that mix, because that is, and it's not going out of business, by the way, that I can assure you, and as far as I can see. And I talk about that in the book too. But that's the value of your Social Security account, at the age of when you retire, is something like $400,000, $500,000. So in that condition, if you had $400,000 or $500,000 all in stocks, you'd be at 50-50. And look at stocks not as a capital generator, but as an income generator. You're looking for income. So see the income that generates, and don't peek at the price every day. So that's the stock market, maybe 7%, give or take. Reasonable expectation is what that is, not a prediction. And that means your money would double in 10 years. 7%, the famous rule of compounding. Divide the number into 72, and there's how long it will take to double. Duh, we all know that. And so what about bonds? Bonds are terrible today. You all know interest rates have rarely, if ever, been this low. The 10-year Treasury bond is at 1.6%. The 10-year, the long-term Treasury bond is at 2.8%. Corporate bonds are in the 3 to 3.5% range. So I do think you need more corporates just to get a higher yield and take a little extra risk. But if you can look at the bond market as giving you maybe, I don't think you should go much more than 2.5% or 3% over the next 10 years, because today's yield, that's all there is in forecasting bond returns. Today's yield has a 91% correlation with the return you will get in the bond over the next decade. So we can pretty much safely say for a bond the returns will be between, let me say, 2 and 3%. It might be 1.5 and 3.5 or 4%, but in that range, it's not going to be 25%. It's not going to be 0. So at say 2.5% for bonds, your money would grow by 35%. So it's not nearly as good. This next bull market, I think, this next decade in the market, not necessarily a bull market, just a normal market, the heavy lifting will have to be done by stocks in your portfolio. Whereas in the last decade, the decade beginning in 2000, when there was two great bear markets, 2000, 2003, and 2008, 2009, huge bear markets, 50% in both cases. Tech boom collapsed, the financial system blew up. That was not a good decade. And so the heavy lifting then on a portfolio was done by bonds. So bonds then, stocks now, I think that's reasonable. But don't get carried away with taking too much risk. Everybody has to decide that for themselves.
How you think it's going to matter with the economy if tax rates, if capital gains go up a little, or?
Well, I think it's highly likely. To me, my own philosophy. Let me talk about my own philosophy, and then I'll talk about the likelihood that it will happen. And my own philosophy is that the lowest tax rate should be paid by citizens who are earning money. They're earning income. They're working by the sweat of their brow or the furrows of their brain, or whatever phrase you want to use, and that should be the most reasonable tax that we have. How we got what we used to call, I mean, when I came into this business, believe it or not, the tax on, quote, unearned income, quote, was as high as 90% on dividends and capital gains. It was this is a wartime tax, and it eventually went to 50% compared to I guess 35% ordinary income tax. I can't remember the exact number. And somehow we got this thing turned upside down. And people made this absurd, stupid argument. Did I make myself clear so far? That if we have to have low capital gains taxes to do capital formation. That has nothing to do. The capital gains are earned by people who are trading with other people in Wall Street, almost all of it. And I don't have any trouble at all in saying we should have one kind of a tax rate, capital gains tax rate for people that build businesses. That's what's supposed to be encouraged. But to allow gamblers to pay the lowest taxes available in America just makes no societal sense, no economic sense. It just creates a large incentive for gambling. And this is right out of, I think, he's not quite my last Republican. I didn't vote for him either, Teddy Roosevelt. But right out of his book, read a speech called The New Nationalism he gave, and I believe, I think it was 1911 out in Osawatomie, Iowa, called The New Nationalism. He talks about the way the system should work. And he believes strongly, as I do, in the inheritance tax. He believes strongly that gambling income should not be favored over earned income. And the capital formation has become such a tiny part of what we do in our financial system. $250 billion, to give you a number that's in the book, a year, and providing capital to new businesses. And we trade with each other 33 trillion. 33 trillion. 99% of what we do in Wall Street is speculation, and 1% is long-term investment. It just not a good idea. So I think capital gains rates should go up. That utterly ghastly, unacceptable, horrifying, counterintuitive so-called carried interest that allows hedge fund managers to say their earnings come not from fees, but from their share of the profits, if any. And that also gets considered a capital gain rather than earned income. And how that ever happened, why the system, and basically how you could ever allow that to happen. It's got to go. And people use, and to give you a little bit of my thought process, people say, yeah, but if you do away with if you keep the carried interest exemption, doing away with it would only save you, let me say, $800 million a year. And I say, yeah, but if it's wrong, let's fix it, whether it's 800 million or 800 billion or 8 trillion. And that should be fixed, and I hope will be. But the Democrats, of course, come from the great state of New York, and the great state of New York is home to the great street of Wall. And it's going to be hard to change.
TC?
Thank you. Gentlemen, thanks for doing this today. Really appreciate. I'm a huge fan of Smerconish because my wife listens to 1210 all day, and 9 of the 10 stations are set at 1210. Jack, I've been an advocate of indexing for 30 years, a Vanguard lifer, so to speak. And I ran a trust department early in my career, and I realized that you really can't beat the market over any significant period of time. Why not lower costs, do that well? So I'm a huge fan of yours. And by the way, I've ushered in church where you and your family come most weekends, and I know you sit in the same row every time.
We do.
Huge
Hopefully
fan.
that will give the Lord a good impression of me.
Huge fan, and it happens to be row 76.
You're one up on me.
But I wanted to just step back, because I mentioned that I'm a fan, but I want to introduce another idea. We're in a business school, and one of my businesses is consulting in compensation. I've done this for 35 years. And I heard a very compelling presentation by, I'll mention another Ivy, Columbia Business School professor last year. She did research since World War II. She actually went to find the records in Harvard's basement, because prior to Edgar, there were no records of public companies kept that far back. And she found that the S&P 500 the growth in the companies tracked exactly the growth in executive pay for the S&P 500. Very fascinating. Her thesis also was that the job of CEO, witnessed by the firings this year in the past few years, has gotten so complicated that an individual, it's very difficult to find the right person. The old saw of coming up through the mailroom. Now you've got to be a lawyer, a market analyst, a financier, a public relations expert, an accountant, all those things to be a CEO today. And we all know there are excessive examples in the United States today. They're terrible, they're detracting, they're tremendously bad. I just wanted to hear what your thoughts were on this, because I'm here to speak that there are some examples of good governance. There are some exceptions. And when we talk about that there are problems of excessive pay, there still are some examples that are noteworthy in the United States.
You want to respond to that?
Sure, I'll respond briefly. And number one, and I said this before a CEO forum, did not make them happy. I said, my impression is that all CEOs are overrated. And I believe that profoundly. And then I added, they looked a little sour, I said, and I was the most overrated of all. It's not that complicated. There are only so many things you can do. You have to have, in many cases, the very talents you live. But the idea of the CEO, and I'm being the CEO of a tiny company. We had 28 people, and it was really fun. And the fun starts to vanish when you get huge bureaucracies. You have to delegate too much. I've never been known as much of a delegator. We talk about teamwork being an important thing. It is the most important thing. I just happen not to be very good at it. I'm kind of a dictator. So we all have our own styles, and there are some good ones. But what we've gotten into is a failure of the compensation system. And, I don't know how to figure out who the good ones are or the bad ones are, but I can tell you some of the things that I think are wrong in the system. I'll just say very briefly two things that are wrong. One is, and Ken Feinberg, who did all that compensation work, says, well, the CEO compensation is fine because it's done in a competitive market. False. It is not done in a competitive market. It is gone, I talk about this in the book, it is done in a consultant's market. Executive compensation with consultants. And they don't look at your performance, they look at your peers. So everybody is in a quartile. And the directors of a CEO in the fourth quartile look at that, and they find that he's in the fourth quartile, and they say, oh, not our Harry. I mean, he's not a fourth quartile guy. He's a first quartile guy. So he goes up to the first quartile. They give him a big raise, big bonus. Well, when that happens, guess what? Somebody else falls into the fourth quartile. Okay? So we have this ratchet effect. Warren calls these firms ratchet, and bingo. So that's part of the problem. The option problem is another one. Thinking options are free. For years, they weren't even charged against earnings. They were looked at as free. They're not free. They dilute the interest of the other shareholders. And the other problem is the head of a billion-dollar company is sitting on a billion-dollar pool of assets. If you can't earn something on that pool, you're a moron. So let's say that we set a cost of capital at 7%. No bonus for the CEO until the return on capital exceeds 7%, and then only a bonus on that part of the earnings that are in fact above 7%. In other words, you don't get everything like a threshold. You start to earn your money if you can earn your cost of capital and more. These are very simple concepts, so simple that no one follows them. So I find it distressing. I agree with you. There's some good CEOs out there. They're a little hard to identify, and oftentimes, sometimes you see one that's good, and the next day he's in the slammer, metaphorically speaking. Like Dennis Kozlowski. Woo! So I don't know how to do this, but I think the consultants have far too much power and far too much persuasiveness with the board of directors. And the consultants are really working for the CEO. The directors don't pay anything out of their own pockets. It's all company money, and the CEO calls the tune. And it's just not a good system. And it can be fixed, I'd say, relatively easily, except that there's no vested interest in fixing it by the people that should be responsible, making sure the CEO is fairly paid, given great incentives to stay there if he turns out to be doing a good job. And that, of course, is the shareholders. If the directors aren't going to do it, then the shareholders will. And so that's why this passivity of letting this corporate monster, for the want of a better word, run on its own, gatekeepers that failed.
One final question for Mr. Bogle, who then has graciously agreed to sign books for those who are able to stick around and have the interest. TC?
Mr. Bogle, I'm in the back, way in the back. We got here too late, so we had to stand. My question will be very brief. A two-part question, actually. Number one is, based on your theory of your age as your bond ratio in your portfolio, you have roughly 80% of your personal portfolio in bonds. With the 10-year Treasury at 1.6, we're advising our clients that there's a potential for a bond bubble at some point when rates start to go up, and we're trying to protect our clients from that. So that's the first part of the question. Second part of the question is, I work at a brokerage firm based in West Conshohocken, Benning and Scattergood, and we do a lot of municipal bond work. So we've issued 90 deals this year to help municipalities bring down their cost structure. We've also assisted in smaller companies to raise money to thrive if somebody has an idea in terms of IPOs and secondaries to supply capital. Why do you have so much, I don't want to say hatred because it's not the right word, but you're so kind of bitter about Wall Street and about what we do to help our clients succeed?
Well, that's a bunch of questions, and I'm not sure I can really answer all of them. But let me say this about the bond position relative to your age. My objective is pretty much to keep what I have, and if I earn little on that, fine. I get, even the great Bogle, when the stock market is going up, thinks, God, I ought to have more in stocks. And when it's going down, guess what I think? Oh, God, I ought to have more in bonds. And so when those two things happen and it really gets steep and extreme, I take my own advice. I read one of my books. It's like Alcoholics Anonymous. We'll call this Bogle Anonymous. But today the bond market is not very attractive. I agree with you on that. But you have only limited recourses, though. I do not approve of trying to get out of the market return. I do approve and strongly commend the idea. The problem with the bond market index yielding 1.6% or 1.7% now is the index is 70% treasuries. It is my personal view that you don't need 70% in U.S. treasuries, which are at such a disadvantage to corporate bonds. Maybe corporate bond yields are 100% higher than that in some cases. So I think people ought to consider higher yielding bonds, but not go after the junk bonds, and all that additional credit risk is there. There's a school of thought that says buy income producing stocks. And of course we have a high dividend fund at Vanguard and a dividend growth fund, and both of those would be acceptable choices to get your return up a little bit. But for most fund investors, as you know from my litany about the amount of dividend income that's consumed by mutual fund managers, 2/3 of the total, the easiest way to get more income is to go from an actively managed fund that yields 0.7% net to an index fund that yields 2.1% net. Just simply getting rid of the active management cost. And that's an intelligent thing to do. There's a school that says buy higher income producing stocks, I mentioned, and you could probably get a 3% yield out of that, give or take. And so I don't think anybody should follow slavishly any rule. I've used my age-based rule as a rule of thumb, and even I am talking about making some modifications, as I have this morning, to it today with a heavier weighting of corporates and maybe a rethinking of whether you shouldn't have a little more in equities. I'm not going to do that myself. The time you get tempted to do that is when times look good. So, as to your thing, I appreciate your candor about I don't know if you used the word slamming, but you might have, slamming Wall Street. And I mean that in a collective sense. There are obviously in Wall Street many good people. I think they are outnumbered by the greedy people and by the people that are doing things in their own interest rather than the interest of their clients. It's a personal opinion, and I think I could buttress with quite an array of facts. But, you know, I paint with a broad brush, and people will have to take what I say and winnow it down, or winnow it up for that matter. You know, maybe I'm too easy on all these souls. But it's not something I particularly love doing, but, you know, as I said about, you know, my basically approach to the issues of the day, I try and perceive what is the best thing to do for investors, and as a group, that is not what Wall Street does. Wall Street acts in its own interest rather than accepting some responsibilities as a trustee or fiduciary for other people's money. And that has to change, and it will change. So if anybody's offended by what I say, I'm not sorry about what I said, but I am sorry if I offended you. That's kind of a half an apology.
Dr. Magidi, thank you so much for hosting us at the Villanova School of Business. We really appreciate your hospitality. Ladies and gentlemen, Jack Bogle.